And I'm delighted to be joined today by my good friend Steve Mitchell, and we're going to have a quick look, I suppose, back at 2020 and a slightly longer look forward at 2021. If I'd asked you, Steve, a year ago what was going to happen in 2020, you'd have got it all wrong, wouldn't you? As did I.
Yeah, totally. I mean, we were preparing for a really good year on the letting side. There was a lot of opportunity for growth. In terms of purchases, we had some personal purchases lined up, and we were supporting some customers who were looking for us to look to source for them. But when we got to sort of around about February, things started to go a little bit wobbly. I came down with a really bad cold. I have no idea if it was COVID, but yeah, things started to go sort of around about the end of February. And then it sort of slowly got worse, and then over the summer it sort of fell off a cliff, and now it's sort of trying to crawl our way back up again. So, yeah, it's the Queen would call it annus horribilis. I would call it probably the worst year I've ever known. But hopefully, going forward, things might look a little bit better.
Absolutely. I mean, realistically speaking, this is maybe once in 100 years event, although it might happen in 50 years or whatever, but it's not something that I'd ever seen before. It's not something that you'd ever seen before. It's not something that had ever occurred in our entire lifetimes, let alone in our sort of trading histories. So here we are at the cusp of a new year with a vaccine being rolled out and people getting their doses now, and with immunity, I guess, building up. Not just in this country, but around the world. And so in 2021, things are going to ease up a bit, quite a lot perhaps. How do you see things panning out? Let's start in the first half of 21. How do you see it all beginning?
How do I see it all beginning? I mean, well, first of all, no one knows for sure, but the only thing you can really do is sort of go back to, I'm a great believer that sort of history kind of repeats itself. And the nearest that I've got to this, I think, was sort of 2007, 2008, which was the financial crisis, albeit different in its makeup. 2007, 2008 was more of a liquidity issue for the banks, and it was just sort of contained to the banking sector. Obviously, that has knock-on effects to us as property investors. This one, it's completely different. It's not wiped out, that's probably the wrong expression. It's impacted virtually every area of life. But if you go back and look at the impact of the 2007, 2008, and you look at when, from a property perspective, because this is what we're talking about, when that impact really took hold, it wasn't until about 18 months after that we started to really see the effect. If you look at property prices, and you look at sort of defaults, it wasn't until I think sort of mid 2009 that you started to see prices fall from their peak. If you look at the average house prices down to what ended up being the bottom of the market. So with anything that's impacting the property market, it's not sudden. It takes a bit of time to filter through, and of course, government starts to then think about the feel-good factor of the country, because as Brits, we're all invested in the all invested in the property market in one way, shape, or form. And we want to feel good about that. We're different to other European countries. So government intervention is probably the most unknown element, because who foresaw that they would bring in the impact on stamp duty? So all of these things are kind of in the mix. And going back to sort of April last year, we were talking about, from a buying perspective, that maybe end of quarter one 2021 might be a good opportunity. Why? Well, at that point, furlough was going to end at the end of October. If there was going to be impact on abilities to pay mortgage, that would probably come about 6 months after. Banks don't tend to start to talk about repossessions 1 or 2 months after you've missed some payments, but probably between 6 and 12 months they would start to ask some questions and maybe look at foreclosure. So we thought that by the end of quarter one 2021, that might represent some buying opportunities. But of course, what does the government want now? It certainly doesn't want headlines about people being being repossessed. That's just sort of more bad news on top of bad news. So when you start to look at the supply and demand, because price is a function at the end of the day, in a pure economics perspective, a function of supply and demand. There is very little supply coming onto the market. There is a very little demand, because if you look at the constituents of demand, which is typically sort of first-time buyers, well, they've been almost frozen out the market because the lenders have increased their deposit requirements. So they've been busy saving up money and about to buy something, and suddenly got to find twice the amount of money. So they're kind of wiped out. Second time or second steppers, so these are people who are in properties looking to move on to another property. Well, they've got some equity in their property that they can maybe leverage. But do they want to risk things when things are going a little bit pear-shaped, or we're not quite sure? So what are the risks to that sort of purchaser moving forward? I think a lot of those will be staying put, and certainly a lot of my builder friends have been busy because they're now spending a lot of time doing home renovations, and maybe that market won't move. And then you've got investors like us. So we're active in the marketplace, but because there's little supply coming on and we only represent a relatively small fraction of overall purchases, that whole supply and demand equilibrium is relatively stable. And that's what sort of kept prices either equal, in my humble opinion, or moving up slightly, because you would expect in a pandemic like this that prices would crash, and defaults would rise, which they have been doing, but the banks aren't doing anything about it. And if you look across the pond as to what the Americans are doing, they are saying, well, don't worry about paying your mortgage. Take a year off, and all we're going to do is add it on to the end of your deal. So that means that people stay in their homes. It means that they don't have all the bad press that happened in 2007, 2008, because that was a real bad time over there in terms of repossessions, and we had it to a certain extent here, but nowhere near as bad as over there. And if banks are starting to want to repossess, I'm sure the government would interject, and they would look to put some form of cover in place that meant that the banks don't repossess, because from a newspaper headline test, they just don't want that bad news. So I think for the first half of 2021, I think prices are going to be relatively stable, probably until we get to mid-year.
Now, indeed, and that's where we're going from that point onwards, because by mid-year, it's probably reasonable, and most people might agree that the pandemic will be, fingers crossed, all kind of contained by then. And just as, this thing impacted us with a short, sharp shock. It came out of anywhere, a bit like kind of wars do, if you like, but it takes, they happen very quickly. We need a lot of money to inject to our armed services, and then we spend a lot of time paying it off. By the summer, it will have been time to sort of, hopefully the economy will be chugging away again, but the government will be kind of seriously wounded financially perhaps, and they'll perhaps be looking to make up the shortfall.
Yeah, they will. And certainly from what I've read in the paper this morning, one of the ideas is to start looking at the wealth or the wealthy people sort of over sort of £1 million worth of assets, and doing a one-off tax grab against those individuals. I don't fit into that marketplace just yet, so I'm just below that threshold. But if you've got £1 million worth of assets, or if you're going to be over a certain income figure, then I think that there will be a tax grab against the wealthy. But of course, us landlords and investors have been walloped by government over the last sort of 3, 4, 5 years with various different initiatives that have impacted us. And I think that we are probably easy targets, and I expect more implications or more impact for us going forward in 2021. We've got potential changes in capital gains tax, and a lot of my friends sort of think about, well, is it worthwhile selling your property right now and getting out before that impacts? But the other conversation we're having is, well, why do investors buy properties? A lot of investors buy it as a pension replacement. So if you're reliant on that income to make up a percentage of your retirement planning, and for my wife and I, for us at the moment, it's sort of equating to 50%. Why would we sell asset and potentially get rid of 50% of our retirement income? Because I might get a bit more, if you look at the overall, I might get a bit more in terms of my capital gains, but that's got to be reinvested into something. The stock market is sort of going all over the place at the moment. Bitcoin is probably all right if you're quite confident and you know that type of market. I don't know anything about it, but learning. Would I pump 100,000, 150,000 into Bitcoin right now? No, I'm not that brave. So therefore, it makes sense for me to hold on to the portfolio and have the income come through. And of course, if I don't sell, then I'm not going to be subject to capital gains tax anyway. So this whole prediction, I think that a lot of landlords are going to be flogging their properties and bailing out of the market. I can't see it, particularly if they have bought the properties specifically for pension replacement and retirement planning.
Yes, for a lot of people, property is, isn't it? Rather than a business, it's an investment to produce a yield for them on their money, a good or poor yield, depending on the area in which they invest. But they take a long view, and I think that's right, don't you?
Yeah, absolutely. You don't. There's a saying. Is it buy property now and pay later, or pay now and I can't remember what the phraseology is. It's just slipped out of my head. But yeah, it's got to be the long-term view. I mean, if you're unless you're flipping, and then in this marketplace, I would suggest that again you have to be relatively brave and really sure of your numbers to enter into that market. Property has to be for the long term, but it depends on what type of property you're buying. I mean, if you look at the high street right now, that's just been decimated. There's commercial units that are going very, very cheaply, and the more creative investor will take a look at that asset and be able to do something with it and make a good return. If you're looking at buy-to-lets, well, buy-to-lets are not that expensive right now, dependent on where you are in the country. But the return that you get from your buy-to-let might be not attractive. Certainly more attractive than what's in the bank, but not attractive compared to some of the other property strategies. And if you look at HMOs, which is kind of where I sort of plant my flag, you will get better returns. But at the moment, we're seeing increased voids. We're starting to see a little bit of arrears build up. So there is more inherent risk with that strategy, but it is a better return over the long run. And if you just look at the bricks and mortars, provided you've not over revalued your property, and that's one of the challenges that you have when doing a commercial revaluation, as long as you've not overvalued it, then you should be safe for the long run. And then in any case, if you look at it at a 20-year sort of a horizon, as long as you don't sell, even if your property goes into negative equity, it's only when you crystallize that the impact comes back and bites you. So as long as you don't have to sell and you've got customers paying the rent and that's servicing the mortgage, and as long as you're mortgage worthy, then you shouldn't really have a problem.
And I think picking up on what you were saying about HMO revenues being a bit down at the moment, having a few voids, it's probably worth pointing out that HMO revenues in the first place are higher than single let revenues. So it may be that even with your slightly lower revenues than normal, you're still doing pretty much okay.
Oh, for sure. For sure. I mean, if I compare, my best buy-to-let gives me about £360 a month. And my worst buy-to-let probably gives me about 270, 280. My worst HMO at the moment is still delivering me like 600. So yeah, it's a lot better. But if you're self-managing, it does require a little bit more input and being a little bit more vigilant about the revenues coming in. And building, as we've always talked about, building good relationships with your customers, so that if there are problems, they have a constructive and positive dialogue with you. Not just don't pay their rent. They go on radio silent, and you're wondering what's going on.
I suppose one of the key things about 2020 is that we were all in it together, whether we were property owners, whether we were landlords, whether we were tenants, whether we were consumers on the high street, manufacturers. Everybody was kind of suffering, and perhaps that led to people, everybody understanding everybody else's position a little bit more than might otherwise be the case.
Yeah, we are all in this together. You're absolutely right. And one of the things that we did in our business really early doors, which, to be fair, is something that we probably should have done, was two things we should have done early that we didn't. One is to really understand our customer base across the HMO portfolio a lot more. What do I mean by that? Well, at the beginning of the pandemic, a lot of my friends who've got HMOs in London just saw all their European customers just up and left. I mean, literally thousands of people left. A good friend of mine who's got lots of HMOs across North London, he was reporting that about 25% of his customer base just upped and left. I mean, what do you do in that situation? So looking at the makeup of your customer base as to where they come from, and of course, with us approaching the 1st of January, do we really know what the implications are for a deal or no deal? No is the answer to that. What are the implications on residency rights? Although a lot of it has been guaranteed, you still need to check to make sure that your customers are entitled to be here. And if they're not, then that's down on you. So you've got to make sure that you understand that. But also we started to look at our customer base in terms of professions. What do they do? Are they self-employed? Are they PAYE? If they're PAYE, what industries are they in? Are they in key worker industries? Are they in hospitality? So if you start to look at your customer base in those terms, you can gauge probably a little bit more the risk in your portfolio from your customer base as to what may happen if certain events transpire going forward. At the moment here in Bedford, there is rumour going around the town that we may be going into Tier 3 as of the 14th of December. If that happens and all the restaurants close down, and 12% of our customer base are in the hospitality sector. So thank the Lord for furlough. If we didn't have furlough, I have no idea where we would be. Certainly a much, much, much worse position than we are now. But just understanding what the impact of going into a Tier 3 area might mean for your customer base, I think is really important. If you've got all key workers and lots of nurses and doctors and healthcare professionals, well, it's likely that they are probably going to be remaining in employment. And if that's 100% of your portfolio, then there's minimal or little risk to your income. If all of your customers are in hospitality, then I would suggest there's probably a bigger risk to your income, and that's something that you should understand and know.
And so to sum up, do you think 2021 is going to be characterised as a year of challenge or a year of opportunity? Would you?
I still think it's on the fence. Personally, a lot of my friends are saying it's rife with opportunity, but I still think we're too early into this pandemic to really know how this is going to pan out. If you look at if you've watched the news recently, you would have seen that from a vaccine perspective, they won't be able to vaccinate the globe probably until early 2022. So if you can't do that, what does that mean? Well, that means that travel is probably going to be restricted. If travel is unrestricted, then is there an opportunity for this to happen all over again? We know how virulent it is, and recent reports out of Wales where they went into their fire break and that had a short-term effect. Well, they're now back up to more cases per 1,000 than when they went in before the fire break. So even with all this lockdown, the propensity of the British public is that we tend not to follow the rules. And if we tend not to follow the rules, then there is a lot of unpredictability coming in. Plus also the fact that 1/3 of the population has said they don't want to take the vaccine, and we need 70% of the population to get what's called herd immunity, even though the experts have said that there's no guarantee that you won't catch it again. I think that next year, I don't think it's going to be as bad as this year, but I don't think it's going to be a bed of roses. So in terms of the property market, I think that opportunity will come in the form of what's happening on the high street, shops and uppers, being able to convert that type of property back into residential could be a big opportunity. There's a big discussion at the moment about what's going on in the high street. If I walk down St Neots High Street, which is the nearest one to me, the predominant retail outlets that you've got are either charity shops food establishments, and for some bizarre reason, barbers and hairdressers. That sort of characterises. So how is that going to impact people going forward? We're going more online, so I think from a lettings perspective, a lot of agents are now looking at online solutions. How can you do things in a low touch way? So I think there's a big opportunity for lettings businesses to capture more business by moving their business online. But in terms of investments, I don't see big drops in house prices the first half of the year. I think if we start to struggle getting towards mid-year, I think buying opportunities might start to appear on the horizon going into the second half of the year. And if you've kept your powder dry, and if you've got your cash pots and investment pots and pension money ready to go, I think that's the opportunity to buy. But at the end of the day, who knows? We could be completely wildly off. Something else could come out of the woodworks and completely derail us. So I think that risk assessment of risk is vitally important. I think keeping your powder dry and being very selective in terms of the investments you make, and make sure that you get a good return on that. The old adage that we make money when we buy property, not when we sell property, is definitely more applicable now than ever before. And if an opportunity presents itself, then go for it. But just make sure that you understand the risk that is prevalent in that opportunity, and that you've got a means to get out of it if it all goes a bit sour.
Well, Steve, thank you very, very much indeed today for your considered assessment of 2021. And may I just take this opportunity to wish you and everybody watching a wonderful Christmas and all the very best for the new year.
Take care.